Welcome to Market Brief After Hours. We have a packed show tonight as we break down a highly active day across global markets. Wall Street seemed to lose its footing today, with major indices closing flat to slightly down. It feels like investors are caught in a tug of war between high-stakes corporate earnings and a sudden spike in geopolitical tensions that is driving oil prices up. What is the big picture driving today's market action?
The primary weight on the market right now is the energy sector, specifically a sharp rise in crude oil. Brent crude futures jumped about 3.4% to settle at $94.07 per barrel, even briefly crossing the $95 mark. Meanwhile, West Texas Intermediate, or WTI, climbed roughly 3% to close at $86.83. This surge is directly tied to escalating tensions between the U.S. and Iran. We saw an 11th straight round of U.S. strikes against Iranian targets. Comments from Secretary of State Marco Rubio, suggesting Iran isn't serious about talks, and President Trump threatening to target Iranian infrastructure if shipping in the Strait of Hormuz is disrupted, have traders deeply concerned about supply lines.
And that concern over oil has a direct line to inflation and what the Federal Reserve might do next, doesn't it? Let's look at how the major U.S. indices wrapped up the day under this pressure.
Exactly. Higher oil prices raise the specter of persistent consumer goods inflation, which could force the Fed to keep rates higher for longer, or even hike them again. Looking at the final numbers, the S&P 500 ended slightly below the flat line, dropping 0.14% to close at 7,499. The Nasdaq Composite slipped 0.57%, ending at 25,691, heavily influenced by some pre-earnings caution in tech. The Dow Jones Industrial Average was virtually unchanged, losing just about 6 points to close at 52,219.
It is fascinating to see how sensitive the market has become to the rate outlook. Just a week ago, traders were pricing in a very low chance of a rate hike this month. Where do those expectations stand now?
It has been a dramatic shift. Fed funds futures traders are now pricing in a nearly 34% chance of a rate hike this month, up from just 10% a week ago. And looking further out to September, there is a 78% chance of at least a quarter-point hike. Portfolio managers are pointing out that inflation remains stubbornly elevated, and there's a growing feeling that the Fed's hands might be tied, leaving investors wondering where interest rates are truly headed.
While the U.S. struggled, European markets seemed to tell a different story today. They actually managed to close on a pretty firm note. What went right across the Atlantic?
Europe benefited from a mix of solid corporate earnings and some very encouraging economic data, which helped offset the geopolitical worries. The pan-European Stoxx 600 climbed 0.58%. Looking at individual countries, the UK's FTSE 100 gained a strong 1.24%, Germany's DAX rose 0.58%, France's CAC 40 jumped 0.89%, and Switzerland's SMI edged up 0.12%.
That UK performance is particularly striking. Was that driven by the inflation data you mentioned?
Yes, UK consumer price inflation slowed in June to 2.6% year-over-year, down from 2.8% in May. That was actually lower than the 2.7% analysts expected, marking the lowest level since March of last year. Core inflation, which strips out volatile items like food and energy, remained unchanged at 2.6%. We also saw a slowdown in factory gate prices, which rose 3.5% year-over-year in June, down from 3.7% in May. This easing of inflationary pressures gave European investors a real reason to buy.
And there were some interesting data points out of Belgium and Iceland as well, correct?
Absolutely. In Belgium, the consumer confidence indicator rose to -5 in July from -7 in June, marking its fourth consecutive monthly improvement. Over in Iceland, the unemployment rate plummeted in June to 3.9% from a staggering 8.3% in May, representing the lowest jobless rate there in 9 months. So economically, Europe had a very supportive day.
Let's shift our gaze to Asia, where the market action sounded incredibly choppy. How did those markets close?
It was a mixed bag. In Japan, the Topix gained 0.45%, but the blue-chip Nikkei 225, which had surged over 2% earlier in the day, ran out of steam and ended 0.18% lower at 66,116. In South Korea, the KOSPI finished 0.7% higher, though it gave up much larger early gains. There was a lot of caution ahead of major U.S. chip earnings, which heavily impacts Korean heavyweights like SK Hynix and Samsung. SK Hynix actually reversed an early 9% surge to close slightly lower.
And what about China and the rest of the region?
China's blue chip CSI 300 index fell 0.5%, while the Shanghai Composite ended flat, and Hong Kong's Hang Seng dropped 1%. On the positive side, Australian shares rose 0.3%, led by miners and energy stocks. New Zealand's NZX 50 rose 0.8%, hitting its highest level since July 9th, boosted by a 12.8% jump in Sky City Entertainment. Taiwan's TAIEX climbed 1.34%, led by 10% surges in WeWin and Nanya Technology, though TSMC slipped 0.41%. Meanwhile, India's Sensex fell nearly 1% to 76,755, and the Nifty dropped 0.79% to 23,996, dragged down by rising oil prices and a weaker rupee.
It seems like the ripple effects of oil and interest rates are global. Speaking of interest rates, we have some major updates on the U.S. housing and bond markets. But first, we are going to take a very quick break for our sponsors. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were talking about global equity markets. Now let's pivot to the U.S. bond and housing markets, where borrowing costs are hitting some eye-catching milestones. What is happening with mortgage rates?
We are seeing borrowing costs climb to heights we haven't seen in nearly a year. The average U.S. 30-year fixed mortgage rate for loans up to $806,500 rose to 6.69% for the week ending July 17, 2026. That is up from 6.65% the previous week and represents the highest level since August 2025. Interestingly, despite these high costs, overall mortgage demand actually rose 1.9%, driven by a 5.5% jump in purchase applications, though refinancing fell 2.4%.
That is incredibly resilient, and I assume this is closely tied to what is happening in the Treasury market.
Absolutely. Treasury yields edged higher across the curve as investors digested those Middle East tensions. The yield on the benchmark 10-year U.S. Treasury note rose more than 3 basis points to 4.63%. The 2-year Treasury note, which is highly sensitive to Federal Reserve policy expectations, gained over 4 basis points to reach 4.264%. Even the longer-dated 30-year Treasury bond yield ticked up to 5.133%.
With yields and rate expectations like this, the currency markets must be seeing some significant technical setups. Let's walk through the major currency pairs, starting with the euro and the pound.
The Euro-USD pair is consolidating near its recent lows, closing slightly up by 0.10% at 1.1410. Technically, it remains in a very bearish medium-term trend, trading well below its downward-sloping moving averages. To give you the specific numbers, the 50-day simple moving average is at 1.1509, the 100-day is at 1.1578, and the 200-day sits at 1.1636. If it breaks below the recent low of 1.1398, we could see a rapid move down toward 1.1350.
And how is the British pound holding up against the dollar?
The GBP-USD pair is virtually flat, closing down just 0.02% at 1.3372. It is currently sitting right on its 50-day moving average of 1.3371, but it faces heavy overhead resistance from a cluster of moving averages just above, with the 100-day at 1.3400 and the 200-day at 1.3399. It is in a bit of a defensive consolidation phase right now.
What about the Swiss franc?
The USD-CHF pair extended its rally, closing up 0.23% at 0.8145. This pair is in a powerful bullish trend, trading substantially above its 50-day moving average of 0.7989, its 100-day at 0.7925, and its 200-day at 0.7917.
Let's look at commodities quickly before we move to corporate earnings. Gold and silver both staged nice rebounds today.
Yes, they did. Gold closed up 1.29% at $4,132, recovering from an intraday low of $4,076. Despite the jump, it remains structurally weak, trading below its 50-day moving average of $4,277 and its 200-day at $4,480. Silver also staged a relief rally, closing up 1.51% at $59.65, though it remains well below its 50-day moving average of $67.39. It looks like a temporary pause in a broader downtrend for both metals.
Now let's talk about the massive corporate earnings that dropped after the bell, starting with Google's parent company, Alphabet. They reported some staggering numbers, but the stock still fell after hours. Walk us through that.
This is a classic case of the market focusing on the cost of future growth.
Alphabet reported a 25% increase in total revenue to $120 billion, beating estimates of $117 billion. This was powered by an incredible 82% growth in its cloud computing division, which brought in $24.8 billion. Net income actually quadrupled to $112 billion.
Those sound like phenomenal numbers. Why did the stock drop more than 4% in extended trading?
It comes down to free cash flow and AI capital expenditures. Google's free cash flow turned negative to the tune of $5.9 billion for the quarter. The company is burning through cash to build out its AI infrastructure, with the vast majority of its $44.9 billion in capital expenditures going toward technical infrastructure. Even though YouTube ad revenue rose 13% to over $11 billion, investors are clearly anxious about the sheer scale of AI spending and when it will fully translate to the bottom line.
And Tesla also reported after the close. It seems their story was a bit of a mixed bag as well.
Yes, Tesla shares slid nearly 3% in extended trading. While their revenue topped estimates, their second quarter earnings came in weaker than expected. It has been a tough year for Tesla, with the stock already down 17% in 2026. However, earlier this month, they did report a 25% year-over-year increase in auto deliveries, so they are trying to find their footing.
We also had updates from IBM and Supermicro. What stood out there?
IBM shares actually rose about 2% after hours, despite trailing consensus estimates. They brought in $17.16 billion in revenue against the $17.58 billion expected, and adjusted earnings missed by 4 cents. But the market seemed to have already priced in the bad news following an earnings warning last week. Supermicro was the star of the day, with shares surging 19% after reporting preliminary fourth quarter results that showed much stronger profitability than expected, which completely overshadowed their revenue coming in near the low end of guidance.
That is a massive move for Supermicro. Any other notable market movers we should highlight before we wrap up?
A couple of others. Westinghouse Air Brake Technologies closed up more than 10% on strong net sales of $3.18 billion. CME Group rose 5% after beating earnings expectations. On the downside, Pegasystems plunged over 16% on weak earnings, and Reddit closed down more than 8% following reports that they are considering cutting off Google's access to their content for AI training.
A highly consequential day of trading, from geopolitical oil spikes to massive AI spending bills. That is all for this episode. If you find this useful, please follow Market Brief after hours.